Hej, välkommen till Börslunch på efn.se. Ja, idag är vi här igen för andra dagen i rad på Nasdaq Times Square för att ta tempen på den amerikanska marknaden.
Och idag har vi med oss Bourdain som är mäklare på Handelsbanken och vi har Kevin och Dags på Stifel and Nicolaus. Welcome to the both of you.
It's good to be here.
Christopher, tell us a little bit about yourself and what your role is at Handelsbanken.
Well, Handelsbanken, as you know, is one of the top banks and brokers in Scandinavia, of course, and we have equity research that we produce in the 4 Nordic countries. And my role is basically promoting and marketing our research and trading to American and Canadian fund managers.
And you, Kevin, tell us a bit about yourself.
I work for Stifel Nicolaus. We're headquartered out of St. Louis. We're the largest mid-cap firm on the street. Cover about 1,400 names. And I head up our international institutional effort out of Boston, taking companies and analysts to continental Europe into the Nordics.
You've been a lot to Sweden, haven't you?
A lot.
A lot.
It's a great place.
Good. Should we start off by talking a little bit to get a sense of the general market right now, where we are? And start with you, Christopher.
Sure. I mean, our market coverage, as you know, is fairly narrow. I mean, we cover only the Nordic region, but many Nordic companies are globally exposed and global leaders in what they do. So we do, of course, follow broader trends. I think people at the moment, I would say, are probably worried about a few things. I mean, China has been a big topic all year long in every market, I think, and that's been affecting people's mood, sometimes on a good day upwards, sometimes on a bad day downwards, and I think that's probably a constant theme through 2015 in terms of how people feel about that, and is China going to slow down more, or is it going to pick back up? What will that mean for especially industrial stocks, I think, is the big question there. But I think the main thing is people still are probably looking for opportunities to buy more than anything else. My sense that people are looking, where can we buy and invest in things, is still the question, not should we panic and should we sell out. I think that's...
You don't feel any panic out there? No.
I do not, no.
Sentiment the last week or so has, I feel, been like we've worried enough. Where would you say that we stand now?
Where we stand now?
Yeah.
I think that the pain trade's on. The pain trade is commodities, basic materials, industrials. The market's seeking out the highest degree of pain to investors, and where everybody's positioned themselves for growth. We've seen this reversion trade on, and a lot of it's dollar related. A lot of people, like you said, worried about China. We think that China has enough bullets in the gun, so to speak, to avoid a recession. Commies don't do recessions, okay? And it results in revolution, and we just don't think you're going to go into recession in China, and that's why you're getting this reversion trade right now. So right now you're looking at basic materials, industrials, transports, seeing big rally there. The Dow Transports put in a higher bottom on the 28th of September. If you look at Dow theory, the inverse was occurring back in March, where the transports were rolling over. I think now, from now to the end of the year, you want to be long the market, specifically now in the industrial, commodity, basic material trade, and probably going into December, we'll see a shift back into growth.
So we've already seen the bottom?
I think so.
Do you agree?
I think that we're close to the bottom. I think that there will still be bad days or weeks where we might have another 5 or 10% sell-off, but I think in general people will be looking to buy good names they've been waiting to buy for a while when and if that happens. That's my feeling.
Every economic period in history is unique in its own way, and this one is, well, a lot of people argue this is the most unique ever with the low rates and the stimulus and so forth. What would you say, Christopher?
Well, I think just on that topic, one of the more interesting things currently that we really haven't seen before is we have interest rate structures in most developed countries that are basically lower than during the Great Depression in the 1930s, when economies are actually not doing that badly. And I think it's very, very rare to see the dividend yield on the stock market actually higher than risk-free rate or supposedly risk-free rate of whatever countries sovereign issues are, and I think that will provide for the next decade a natural support to the market, because I think when you're talking about pension funds, insurance companies that have very, very long-term liabilities in their portfolios, the traditional thinking has been, okay, we're going to have certain allocation to fixed income and get an expected return of something reasonable over there at lower risk profile, and then you'd have some allocation, which of course varies, to equities, and you're taking higher risk from that. But the whole concept is, together, this is going to meet your long-term liabilities or exceed your long-term liabilities. I think what's different now that we really haven't seen before for a prolonged period is the yield on fixed income asset class as a whole is basically near zero. So I think these types of investors who have very long-term liabilities they're trying to plan for over 20, 30, 40 years, they are forced to increase their allocations to equities because they're just not getting that return from fixed income. And I think one of the things that people I talk to maybe sometimes tell me, oh, gee, we didn't think of that, and others, of course, have, is just the way people invest in portfolios over time. You have, at any given insurance company, a fixed income portfolio which is on average been bought 4, 5, 6 years ago. I mean, they're always buying and things are always rolling off. So the whole discussion is here about Fed liftoff and when will rates reverse and start going back up. In some respects is, in my view, almost irrelevant, because I think the actual yield that these companies are getting on their actual portfolios is going to continue down for another 2, 3 years, because stuff they bought in 2013 and 14 will be a larger piece of their portfolio than things they bought in 2005 and 6. Those things are all maturing off.
Seems like you agree.
Yeah.
Yeah?
Yeah.
But at the same time, I mean, we've seen a sell-off in like Stockholm. We're down 20%, and we've had these extremely high dividends all the time. So you could, as you mentioned yourself, we could still see a sell-off of another 10%, even though we have this good.
The thing on Stockholm, though, I mean, you had a massive rally the first 3 months of the year. Now, some people could argue that that rally was currency induced by, you know, a much stronger dollar. We saw a dollar go from 129 euro dollar in September to 104 in January, and you know, the crown is now what, like 810. You know, looks like it could pull back to 765. Got as high into the 9s. I mean, but the end game is to me that the European markets rallied. It was a currency-induced rally, and so where you're off 20%, we're basically all in the same ballpark now. So I think really what we need to focus on is, you know, where we're going to be in the first quarter, second quarter of 2016, and no one's really focusing on that right now. In regards to the U.S. market, you're going to have a very easy comp in the first quarter. You're going to be comping out euro dollar at, you know, 106 versus 112, potentially a positive comp compared to where we were back in 2015. I travel with CEOs all over Europe, and their biggest complaint was, you know, our business is up in Europe, but we're getting crushed by the dollar. And you're not going to have that issue going forward in 2016. And I think it's going to surprise a lot of people. And what I've found, and I've been coming to Europe now for 30 years, is U.S. analysts, U.S. companies don't do a good job of factoring currency risk into the equation.
They don't know how to do FX.
Exactly.
It seems like a surprise every time.
Every time.
Yeah.
Every time. You'd be like, you've got to be kidding me. I mean, you know, when I go to Europe, I feel it every single day. I pull up my bill at the Grand Hotel. I said, you've got to be kidding me. But the end game is that you're not going to have that tough comp in 2016. I think a lot of U.S. multinationals are going to surprise on the upside, because you have a very easy currency comp going forward.
I would agree with that for next year. I think so as well. I think for U.S. companies, it's been a big drag this year, and it's sort of been the big issue. And I agree.
The biggest issue.
It is still a big issue for another couple of quarters. Yeah. But you know, analysts tend to look at things on a year ago comparison, so that will start to look easier next year. I think with the Stockholm market in particular, I think people like me who work at firms like mine 2, 3 years ago, of course, or 5 years ago when things were worse, were arguing, well, if you look at the Swedish market in particular, some of the very largest companies in Sweden have this wonderful exposure to China. So you're selling construction equipment to China. H&M is opening stores in China. You have Sandvik selling mining equipment to people who are digging ore out to sell to China. And I think that in some ways, people started to understand that too well. And so when China turned south, you realize, oh, all of these companies have a very, very heavy exposure to China. So what was a selling point 2-3 years ago that got people very enthusiastic about the Stockholm market in particular, because so many prominent companies had that exposure, turned into a big negative this year, of course, because people understand correctly these companies have a very, very high direct and indirect exposure to China. As you said before, I mean, I think the entire China story is not as bad as the headline China story, because you still have consumers getting on planes and going to Barcelona and spending money and buying expensive Louis Vuitton bags and things like that. Yeah. But in terms of the companies that you see in Sweden in particular, they're more industrially exposed, and that's the part that's going badly in China this year.
Has that affected the international investors or the US investors' view of the Swedish or Nordic or market?
Yes, absolutely.
Yeah.
I mean, I think, all of the Nordic markets, as you know, are actually quite different. I think people who pick up the paper for the first time and start reading about the Nordic markets, I think it's very easy for people who haven't delved in to think, oh, they kind of behave similarly, but actually they are quite different. And, but that is definitely an issue for the Swedish market. I think if you look at the other Nordic markets, there are many more fundamentally negative things happening at the moment in Finland and Norway than there are in Sweden in terms of what should we be worried about for the next 2, 3, 4 years. Sweden actually, among the Nordic countries, is the one that on a macro level is doing the best at the moment, and is probably going to do the best for the next year or two.
And much more diverse,
yes,
if you look at the different industries.
Absolutely. But we're talking 3% macro growth in Sweden for the next couple of years, 2.5, 3, and 1 or less for Norway and Denmark, and negative for Finland. So that's also affecting the picture, obviously.
So going back to the Q3, we're in the middle, or we just started actually. I had J&J this morning, but you mentioned the
Q4.
The FX.
Yes.
Which I saw a research from FactSet that said, the majority of companies, what is the negative thing? FX.
Still is in the fourth quarter.
Much more.
Yes.
Much more than anything else, much more before China or global or whatever. But if you look at the numbers that are coming out now, have the estimates come down far enough, do you think, or going to have further revisions when this is over? It's hard to generalize, but I know that energy is doing very poorly when it comes to earnings, but if you try to...
I think a lot of... We've taken out a lot of the currency risk. The numbers have come down. Okay? But now, the key question is, the market's forward-looking. Let's start looking into the first quarter of 2016. The big descent of the dollar actually started to occur in the fourth quarter of 2014. We saw a euro go from 139. By the end of the quarter, I think it was around 110, 109, and then it traded down to 104. And now you're back, at 112, 13, 14, and looks like it could, we get dollar weakness up to 118, 119. You're going to have a very positive comp in the first quarter of 2016 when no one's factoring in that right now. No one that I talk to anyways.
Right. Okay.
Isn't that the typical broker answer? Like, okay, don't look at this, look further ahead. It looks better than.
The thing is I think they've already, you're right, but I think they've already adjusted for fourth quarter, but they didn't start making the adjustments on currency last year until no one started talking about the dollar until we were already at 104. And we'd come down from 129. So we have to be forward-looking at what a positive comp this is going to be in the first quarter of 2016. I mean, you're still going to have a tough fourth quarter comp, but now I think they've factored it in. But they didn't start factoring it in until the end of the first quarter of 2016, and that's why we have a market that's basically flat for the year.
But I was a bit surprised when Alcoa kicked off the reporting season. The earnings were worse than expected, but they said basically what everyone was expecting. China is doing poorly, Europe and North America is doing okay, and the share was down 6 or 7% when I looked. It might have.
It's the pain trade.
It's
the mean reversion trade. The market is going to seek out the highest degree of pain here We're getting a reversion trade that will probably go into the beginning of December, end of November, and that's when we'll see the growth names come back in. Everybody's right now positioned for growth. In the short term, that's the wrong place to be. In the long term, yeah, but right now...
And going back to Alcoa, we were talking about this graph that we saw between Nike and Alcoa, which I think symbolizes everything about China right now. Nike's doing fantastic. The share is up, Alcoa is down. And you mentioned H&M. They should benefit from the same change or turnaround in China that Nike is seeing.
Well, I think Nike is viewed as, I think it's a more unique brand that will sort of behave differently than more mass brands. And I think that, I mean, Louis Vuitton and those types of brands, I think, are also doing well in China. We took around recently in the US the company that owns Atomic Skis and Salomon Skis and footwear and a Canadian outerwear brand called Arc'teryx, and they reported to us that those brands, especially Salomon and Arc'teryx, are doing extremely well in China at the moment. But they're narrow niche brands, and they're doing very, very well. So.
But listening to you, Kevin, it sounds like we've been paying too much for a company like Nike, and we should be starting paying for companies like Alcoa.
You know, what I'm saying is right now, the here and now, the short-term trade that we talked about is the mean reversion trade. Long-term, I want to be long Nike. We love Nike. We cover it closely. I mean, they're a category killer. They're going to continue to do extraordinarily well. And I think the big benefit to Nike looking out into 2016 is you're going to have these very easy currency comps in the first half of 2016. So I'm not prepared to talk on Nike. We like it, love the name, and again, it's probably a classic example of what I'm talking about, is where the earnings surprises are going to come for in Q1 and Q2.
So what else do we have? We got the FX, easy comparisons going into 2016. Then we have the oil.
Yes.
So where's that heading? What do you think?
What do you think, Chris?
I think oil is going to just be in the doldrums for years, honestly. It's my personal opinion. I think, my firm's opinion for the next several quarters is not going back up.
Okay.
I think one of the interesting things with oil that's making it a little harder to predict is, and I think there was actually a very interesting report I read the other day from the Natural Resources Defense Council, it's an organization here in the U.S. I mean, it was basically showing that oil demand in the U.S., oil consumption in the U.S. is at the level of the 1970s at the moment. The economy, of course, has grown hugely since then, and the population has grown hugely since then. But all of these quiet little advances that you read about in the papers once in a while, which are more efficient cars, change over to more efficient light bulbs, the types of things that Obama likes to talk about on TV, actually, over a very, very long period, are having a very positive effect. So when you see industrial economies like the U.S. actually using the same amount of oil we were using 40 years ago, it's kind of a wake-up call to me. And I think what's also potentially very interesting for the oil markets in a kind of 3 to 4 year perspective, every day you read that people are working on more economically robust power storage technologies. So if you actually came up with something that could store wind power or solar power in a big way and be released during the nighttime hours or low demand hours, that would create an additional huge bump in investment in non-oil using technologies, in my view, because that's the impediment to growth in so many of those markets in terms of producing power. So.
But I thought that the low oil price is an effect of the supply side and not the demand side.
Well, it's both. I think it's both.
It's
I think
always both,
there are
of
other
course,
countries,
but it's more of a
there
supply.
are countries like China growing, of course, that are boosting demand and
Yeah.
all simply because they have growth, and I assume it's the case in India and in South Africa as well.
What do
of
you
course.
think, Kevin?
In the short, if you asked me 2 weeks ago, to me, obviously the trend in crude is down. No question about it. And we're going to be range bound for a very long period of time, very similar back to the 80s and the 90s. Yeah. We went to a bear market in crude in 1982, and I think you put in a bottom in 1999. And I completely agree with you. Short term, however, again, I hate to continue to use the word pain trade, but this move on the dollar is having short-term implications for crude, where I could see crude rallying a counter-trend rally, a powerful rally to the 60-ish level, which would shake a lot of people out of that trade. Okay, and if you get a euro dollar go to 118 that we're talking about, you easily could see crude trade higher here. Long term, I completely agree with you. I think we're range bound in that 35 to 65, 70 range. Yeah, but short term, I think that you're going to get a powerful rally. You can see a surprising rally in crude and these energy names which have been beaten down, and that's where I would be. That's how I would be positioned in the short term.
Could be. I think one of the interesting questions in crude production, in particular, is the cost of getting oil out of the ground is a moving target. So 2-3 years ago, we all thought it cost on average, I don't know what the number was because I don't follow the industry that closely, but let's say that on average the number was $30 or $40 a barrel on average to extract oil. That number has been going down steadily the last 2 years, and that's why if you look at the number of land rigs that have been digging in North Dakota and these places in the U.S., the number of rigs drilling has gone down dramatically in the U.S. the last year, but actual oil output of the U.S. has barely budged. It's only gone down a tiny bit. It's because the technology has improved so much and the cost has gone down. So it's kind of a moving target in terms of how much does that cost and where does it become economically justifiable to continue producing from a well that's somewhere in the middle of the cost curve.
So, gentlemen, it's time to sort of summarize your thoughts and take it down to the investment idea. So maybe pain trades. Let's see.
Let's talk about pain trades.
No, but considering what we've been talking about, if you start with you, Christopher. So where should one position right now in this market?
Well, again, I mean, the focus at my firm is on the Nordic markets, obviously, and so I think the trades that we tend to have liked for these next couple of quarters and into next year and so on have tended to be things where they are more exposed to sort of consumer markets, local consumption, or consumption in other growth markets, or with high exposure to U.S. economy or U.S. auto industry or U.S. spending, because the U.S. has been doing better than every place else in the last year or so. So I would say probably, despite occasional huge rallies like we've seen in the last couple of weeks in some of the commodity-related names, might be a bit too early to think about the big heavy industry names in Scandinavia for sort of people looking for 1-year investment, 2-year investment. I would sooner say look at some of the some of the medical and sort of consumer-oriented sectors. And oil, of course, is a big question for the Norwegian market in particular. I mean, that's because everything in Norway in some way or another relates to spending and money and cash flow coming from their oil revenue.
When it comes to medical, or pain trade, the biotech is hammered from high levels, but still it's really been punished. And I know that one of your favorite, or one of the stocks you like, is one in that area. Oh. Is that a pain trade? Indraxon is the name.
Well, I think first and foremost, we haven't put it in the bottom in biotechs yet. No. Okay, and the average, bear market in biotechs isn't that long. It's about 92 days, and we didn't actually move into bear market territory till about 3 or 4 weeks ago. So I mean, you're still looking, I think, at it, probably a month or two away from putting in a bottom in the biotechs. But one company in particular that we like, is a company called Intrexon, run by a gentleman named R.J. Kirk, who's been very successful. Actually took Intrexon to Stockholm to meet with fund managers in Stockholm and in Zurich back in June. The stock was ripping at the time, traded from 40 up to almost 70, and since the corrections ensued in the sector, 37. Yeah, it's 36, 37. It put in a bottom at 30, but Steve Jobs said when they asked him what's going to be the next big thing, that it's going to be where technology and science meet. Yeah. And that's effectively how I view Intrexon. They have a team of 400 synthetic biologists that basically try to make products better. So whether you're in household products, you're in energy, agriculture, you need to genetically modify something. You're not going to hire your own team of synthetic biologists. You're going to go to Intrexon, and they're going to charge you an upfront fee, a development fee, and a back-end royalty. They have 26 collaborative agreements. In 3 years, they could have 100 agreements. So I think that could be an ex-colleague of mine, Bill Miller, who's one of the most prominent fund managers in the U.S., basically said he thinks it will be the biggest stock of the next decade. That's a name that I like. It's aggressive. We cover it. We have it buy rated. I really like the name.
Excellent. I think we got a new name for our
Fantastic.
Swedish viewers. If anyone is watching who has that share, please let us know. I haven't tried one.
The share of the next decade.
Yeah.
That's
Excellent.
not bad.
Did you have an 800 number?
No guts, no glory. That's right.
No guts,
Right?
no glory. Thank you very much, gentlemen, for being here with us today. Vi är klara här för idag, men vi är tillbaka här imorgon igen och då har vi David Marcus, en legend i finansvärlden, känd även i Sverige för att ha varit mentor för Kristina Stenbeck. Han kommer hit tillsammans med Frank Hathaway som är chefsekonom här på Nasdaq. Vi ses imorgon vid klockan 6. Tack, hej!